In this video, you'll be learning about this topic.
Let's talk about the fair value of Lumen technology and what we call the intrinsic value. I typically use a discounted cash flow or internal rate of return model for calculating intrinsic value. And the free cash flow was actually down in 2019, but seems to be stabilizing with some pretty conservative estimates about how I project the free cash flow to grow over time, meaning a 30% probability, let's say, that the free cash flow just stays flat and doesn't grow from here. I'm still seeing an impressive internal rate of return in the double digits. I'm curious, what do you consider to be the intrinsic value of Lumen, and how do you go about calculating that?
So I'm just going to give just a little bit of a background or some clarity on how we value companies, and I'm going to hand it to Eugene to talk about the valuation. So as a firm, we try to triangulate value. Every firm has an intrinsic value, but as an investor, as you're doing a number of analyses to get that number, it's not like someone rings a bell and says, hey, you hit the intrinsic value. It can be a moving target. Businesses change, management changes, capital allocation changes. All of those things can affect intrinsic value. So we triangulate. So we typically use discounted cash flow analysis. In a company like this, where we think that there are assets that are separable, we'll use the sum of the parts, value level 3 separately from CenturyLink. And then we'll use a typical multiples analysis, like, okay, other businesses trade at this multiple. So, what multiple should this trade at based on the margins and returns? And then if you have 3 legs to your valuation stool, and they're all pointing to a massive dislocation in terms of undervaluation, when you combine that with a pretty good business, at least on the level 3 side, and good management, that's the holy grail for us. And that's why this is one of our largest positions. So I'm going to hand it to Eugene to talk about how we think about intrinsic value. And we're going to focus on the sum of the parts, but we can also talk about the DCF as well, because those numbers are very compelling.
So starting, again, the way that we've looked at it was really, there's a tale of two cities. There's the core level 3 and there's core CenturyLink. And as I mentioned before, because level 3 has publicly traded debt, we can actually arrive at a very accurate snapshot of its underlying financial conditions through its public filings. So if you look at I'll just use 2019 numbers because obviously 2020 is a special year and certainly bizarre in many ways, but I'll just use 2019 as a starting point. So from 2019 numbers, you have 8.2 billion in revenue roughly and about 2.8 billion of EBITDA, which for us, given how we approach the value of this company, is an important metric when we get to kind of like private market value or valuation approach based on similar transactions. So if we take that $2.8 billion and we look at deals within this space that have happened over the past, let's call it 18 months, because we try to keep it somewhat more relevant versus, things that traded maybe 7 or 8 years ago. We look at QT buying Zayo at 12.1 times. We look at Altus selling their LightPath subsidiary for 14.6 times. Look at actually something that hit, I think it was this week, GGT, which was a big roll-up of various parts, but they had 2 fiber assets called Hibernia and Interroute that they just agreed to sell for roughly about 12.8 times. And all these are EBITDA, or earnings before interest and tax depreciation. So if we use those sort of private market values for fiber heavy assets that, have pretty good business connectivity and also add-on services, we arrive at, a valuation range for the core level 3 of somewhere between, call it 31 and $36 billion for that business. And just so you know, when CenturyLink bought level 3, was it 3 years ago roughly now, they paid, I think it was 34 billion, correct? 34 billion was the number. Let's just assume that no value was added for 3 years, which I would disagree with, because I think this is one of those companies that gets more valuable, going back to what Buffett believes in, compounds, right, value every single year. Let's just say it's 34 billion, right? It's kind of the midpoint of that valuation range I just said anyway. So at $34 billion, what are you getting? They have about 34 billion in debt. So that takes out the entire debt stack just from the level 3 assets. Meaning that if you subtract out that EBITDA number that I said, that 2.8 billion, which comes directly from public filings, not adjusted, no magic, nonsensical, whatever billion different adjustments that people make, you get the legacy CenturyLink of 5.8 billion EBITDA for free. Well, not for free. It's what I think the leftovers are 10 billion. So you're getting it at 1.7 times roughly. 1.7 times EBITDA. Or said another way, I mentioned before, CenturyLink had 1.75 billion in free cash flow. You're getting it at 5 times free cash flow? That is insanely cheap valuation for an entity, even if it is, let's say, declining at 2 to 3%. Our premise also, your listeners understand, is that if you look in history, yes, the core of CenturyLink is declining. And I think I mentioned this before, that their major problem really is their legacy voice. That's just going to effectively become zero over time. So that revenue, as it becomes smaller and smaller, will affect the company less and less. And at some point in my model, I think it's about 6 years out, there will be a point where the decline rate there will not be big enough to supersede the growth of core broadband plus small business services plus some of the other kind of regulatory income that CenturyLink has. So assuming that this is not a perpetual decliner to zero, you have a valuation that is so low that, I mean, it's really hard to reconcile the value for what you get, the leftover CenturyLink versus the reality. I mean, literally almost anything that you can think of trades, even if it's declining at 4.5 to 5 times. And if you did that math, right, if you just said, okay, let's say you did that $34 billion valuation for level 3, and you put a 4 times, right? Listen, I'm not even going to go crazy. Let's put a 4 times EBITDA multiple. You're looking at about a $21 stock. If you put it at 5 times multiple, you're looking at a $26 stock. So our premise really is that as long as people wake up to the fact that the core assets of level 3 are worth what they are worth in the private market, or let's say it's around $34 billion. And as long as people apply even some modicum of multiple to the remaining CenturyLink assets, you have a completely insane risk reward from 950 or whatever it's trading at today. So that's kind of our sum of the parts look at how to approach value in the company. And again, for us, it's more about margin of safety. So our margin of safety really is that, look, if someone offered me $1.7 billion today, $1.7 billion in cash flow today, and I only have to pay $10 billion to get it, I would take that bet. That's it in a nutshell.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.